Imagine you're a successful IT contractor in the UK. You've had a profitable year, paid yourself a standard dividend, and moved on. Then, a penalty notice from HMRC arrives in the mail. Your mistake? You missed a seemingly obscure registration deadline on October 5th. Suddenly, your profit extraction hits an invisible wall. For years, company directors could extract tax-free dividends from their limited companies with almost zero administrative friction. Today, that era is definitively over. This chart shows the annual UK dividend allowance over the last several years. In 2017, you could take out £5,000 completely tax-free. By the 2024-25 and 2025-26 tax years, that allowance has been slashed by 90%, leaving a historic low of just £500. And the squeeze is compounding. Legislation is already in place to push dividend tax rates even higher starting in April 2026. At Pro Tax Accountants, or PTA, we advise UK startups and established SMEs on how to navigate these exact shifts in tax policy. For the 2025-26 tax year, calculating your tax liability is only the first hurdle. The real challenge lies in navigating the specific reporting triggers and deadlines that HMRC now mandates. In this video, we are mapping the new compliance pathways. We'll break down the specific HMRC thresholds you need to watch and detail the exact paperwork required to protect your net take-home pay. A minor administrative oversight today guarantees a severe financial penalty tomorrow. The burden of tax efficiency has moved away from passive accounting at the end of the year and directly onto your shoulders for proactive compliance. Let's establish the baseline. Every UK taxpayer has a standard personal allowance of £12,570. Once your salary or pension uses that up, your £500 dividend allowance acts as your final tax-free buffer. Looking at this decision tree flowchart, we can trace the first tier of compliance, the £500 rule. If you receive exactly £500 or less in total dividend income across all your investments and companies, you hit the first outcome. Stop. You owe zero tax and no HMRC reporting is triggered. The trade-off here is obvious. While you avoid the paperwork, capping your dividends at £500 severely restricts your ability to extract meaningful profits from your own business. That brings us to the middle tier, often called the contractor zone. This is where you earn between £500 and £10,000 in total dividends. In this bracket, the rules require a specific action. You must proactively contact HMRC by October 5th following the end of the tax year to have the tax coded out. Coding out simply means HMRC adjusts your PAYE tax code, the pay-as-you-earn system that dictates deductions from your paycheck. Instead of sending you a separate bill, HMRC collects the dividend tax directly out of your standard monthly salary or pension. This method successfully avoids the hassle of filing a full self-assessment tax return, but the trade-off is that it permanently reduces your monthly net take-home pay throughout the entire year. There is a critical data gap here. HMRC does not automatically receive payout data from private limited companies. The legal burden to notify them rests entirely on you, the shareholder. Assuming HMRC already knows about your SME dividend payouts is the most common and costly mistake a contractor can make under the current rules. Now, we shift to established companies and directors extracting more than £10,000 in dividends. This pushes you into the highest tier of HMRC scrutiny. Crossing the £10,000 dividend threshold hits a mandatory legal trigger. You are legally required to register for formal self-assessment by October 5th following the end of the tax year. This timeline maps out the immediate filing outcome. Once registered, you must submit an SA-100, the standard self-assessment tax return document, and pay the balance of your tax due by January 31st. But the SA-100 system introduces a core complexity that catches many founders off guard: payments on account. Payments on account force you to pay your next year's estimated tax bill in advance. HMRC splits this estimated future bill across two strict installments, one in January and a second in July. This creates a severe cash flow trade-off. When a startup founder extracts a large dividend, they face a double bill: the tax owed for the current year, plus a simultaneous down payment on next year's estimated liability. And we have to address the administrative reality of the payout itself. Simply transferring company cash to your personal bank account does not automatically make it a legal dividend. To be valid, a dividend requires strict corporate governance. You must draft formal board minutes and issue a dividend voucher, which must be kept on company records for at least 6 years. If you miss this paperwork and face an audit, HMRC has the authority to reclassify those undocumented withdrawals as standard salary. That triggers drastically higher income tax rates and adds heavy national insurance contributions on top. A dividend is not legally a dividend until the paperwork proves it is. Maintaining perfect corporate hygiene is just as critical to your wealth as the initial tax calculation. The government's pursuit of long-term fiscal sustainability means further tax extraction is inevitable. The autumn budget confirmed specific rate increases taking effect in April 2026. The basic rate for dividends will jump to 10.75%, and the higher rate will rise to 35.75%. With rates rising and the £500 allowance remaining frozen, business owners must aggressively utilize tax-efficient wrappers to protect their income. This quadrant chart maps your strategic options. Notice that utilizing an individual savings account, or ISA wrapper, sits firmly in the high-impact, low-effort category, allowing you to shield up to £20,000 a year from dividend tax. The trade-off of using an ISA is liquidity. While it shields dividend income entirely from that £500 limit, it ties up your capital in specific accounts, reducing immediate cash on hand for you or your business. For extractions under £10,000, payroll coding sits in the low-effort, low-impact quadrant. It offers low friction, but doesn't lower your tax bill. For directors extracting over £10,000, self-assessment requires high effort, but prevents penalties. It's legally unavoidable. The rules have tightened drastically. HMRC's data visibility is sharper than ever, and claiming ignorance of the deadlines is no longer a viable defense. Do not let a simple administrative error cost your business. Seek professional advice to navigate these exact changes and map out your optimal extraction strategy. You can reach the experts at Pro Tax Accountant by calling 07985 689 912 or emailing info@protaxaccountant.co.uk. Please note this video is for informational purposes only and does not constitute formal financial advice. Make sure to subscribe to the PTA YouTube channel for more straightforward tax advice that actually works. In a landscape where tax-free allowances have all but vanished, meticulous, proactive compliance is the only mechanism left to protect your hard-earned profits.